Is Bitcoin's behavior driven by fundamentals, or is it driven by the same type of speculative behavior that is driving the moves in these other assets? We think, at least in the short to medium term, this type of volatility is going to be a feature and not a bug. We think if there was some type of relationship between liquidity, institutionalization, and volatility, we would have already seen some type of corresponding reduction in vol, but we have not. And then the second major thing from a portfolio construction standpoint is the diversification benefit. As Matt alluded to earlier in the presentation, we not only believe that crypto lives out in its own world, but we can demonstrate that through a few different metrics. If we're looking at just a simple Pearson correlation metric, this crypto market cap weighted index that we're utilizing in this slide and that you saw on the volatility sheet, has a slightly negative correlation, roughly zero correlated to 20-year T-bills, and a pretty low correlation to crypto. The point here is that regardless of what quantitative application you apply to the data set, you're going to get the same results, which is crypto behaves on its own.
In Strix Leviathan, find most compelling about the asset class is that opportunity to add diversification to their portfolio. Uncorrelated asset classes that are liquid and growing, these just don't emerge in the world on a frequent basis. As such, cryptocurrency has received an incredible amount of attention, and the investment opportunity is massive. So as you take a look at this space, we've really focused on the opportunity for allocators, but of course, where there's opportunity, there's challenges and commensurate risks. We thought it worthy to talk through a few of these in particular. Drawdowns in this asset class can be quite tremendous. The graph you're looking at on the right is a very short time period. On March 12th of 2020, just after the COVID lockdowns were announced, you saw risk assets across the board of the world sharply decrease in a very compressed time frame. Bitcoin was no different for that particular moment and saw about a 50% drawdown in just a 12-hour period. So despite some of the very compelling opportunities for allocators, there are things to be mindful of, and those are the sharp drawdowns that come with a volatile asset class like this. Custody is very unique in the cryptocurrency world. Blockchain assets are by and large bearer instruments, meaning bearer has the responsibility for ownership and custody of the asset. Therefore, if you lose the asset, there's no one to call. It is entirely up to you to keep it safe. This presents a big headwind for many allocators and has given rise to an entirely new segment of companies providing digital asset custody services. Nevertheless, custody is very unique in this market and quite different from what you would see in traditional asset classes. Nico, do you want to take us through the technical uncertainties that present risks?
Yeah, absolutely. I mean, one of the things we're monitoring always is the behavior on the blockchain itself, as well as smart contract vulnerabilities. A lot of this is still very novel. There's a lot of uncertainties there, even with Bitcoin, which has probably the smallest attack surface because it has the simplest design and the simplest application. But even there, we don't know at a certain point, block rewards are reduced to the point where it's no longer a significant amount of the miner's revenue. And at that point, is there enough transaction fees to incentivize miners to continue securing the network, or are there better ROI opportunities there for them? These are things nobody can know today. I'm not saying that Bitcoin will fail because of this, but this is something we can't know as of today and until we get there. Ethereum, which is going through an immense basically rewrite where they're moving from a proof of work consensus mechanism to a staking mechanism. It's basically a decentralized, semi-coordinated team of engineers trying to solve really difficult problems that have never been solved before, and they're doing it on a global scale with billions of dollars now trading on top of the network. There's just a lot of gray area there still. We started this fund 3 years ago, the business 3.5 years ago, and I would say there's a little bit more clarity, but we still have a lot more questions than answers. And then, of course, there's geopolitical risk. Last week, we saw a province in China shut down mining, and within 24 hours, we saw Bitcoin's hash rate, which is a measure of its security, drop by anywhere between 35 to 45%. Right, so there should be concern there if a large nation with the resources necessary to go after a network, whether that be because they are trying to block their own citizens from capital flight, essentially, or financial privacy. Nations do have the capability to do that. I would say that we have not reached a place where a geopolitical attack from any single nation would not cause harm to pretty much any blockchain that is out there today.
And this is the state of affairs with an asset class that has only been around for 12, 13 years now, that's based on emerging technology that we think is relatively unproven, that is largely experimental, and assets that are entirely used for speculation purposes. So we hope you get a greater appreciation of the risks and challenges that are out there that go hand in hand with those opportunities for allocators. I'll open it up to you in the crowd if there are any questions. We'd love to hear from you and any reactions you have.
Thank you for this presentation, really interesting. So I have a couple of questions. One is the difference between proof of work and proof of stake. And is that what separates those that use a tremendous amount of energy from those that do not? First of all. And second of all, could you give us a quick definition of the difference between proof of work and proof of stake?
Yeah, absolutely. So yes, I would say that's like a dividing line around energy usage. Proof of work is going to use electricity energy to basically brute force and test different combination of characters in order to find the correct combination that will allow a miner to add a group of transactions to the blockchain. And as a reward for doing that, they get what's called a coin-based reward, which is the transaction fees plus some inflation mechanism where a new coin is created. Bitcoin's largest pitch is that its inflation continues to decrease until there is no inflation anymore, and there's only 21 million units. And then proof of stake is a different type of consensus mechanism. And I'll caveat here that there is, within these two broad definitions, there are subclasses of different types of proof of work algorithms and different type of proof of stake algorithms. But in essence, proof of stake is saying, okay, I'm going to put up and lock away $100,000, and you can take that money away from me, or chunks of that money away from me, if I try to add invalid transactions to the blockchain. And in return for locking up my capital, I will earn some yield. For Ethereum, I do not know today what the yield is. They originally floated something between 3 to 5% a year. And that comes from transaction fees and inflation within the currency.
A couple other questions. So if I've decided, well, I like this asset class and I want to get into it, or I want to get my client into it, there's, I think I read somewhere, something like 6,000 crypto assets out there.
That's right. That's right.
So how does one go about making a selection? I mean, obviously one way would be an investment fund like yours, but another way, but suppose you wanted to go direct, how do you sort out, which ones to invest in?
It starts with some type of investment thesis, particularly if you're looking for a long-term investment. What do you think is important in this space? Is it a digital store of value? Is it a stable transaction mechanism because cryptocurrencies exist for that? Or is it Web 3.0? I think the entire internet is going to move to a decentralized platform. And then within that thesis, start drilling into what exists today and what people are building.
Would it make sense to take a buy and hold passive approach to this asset class, or it's sounding like, what makes sense is, take a very active trading kind of approach?
Yeah, I think I would bifurcate that depending on what you want. I think an active approach is the best approach, just because you have some control over the forward distribution of returns. You can't promise anything, obviously, but if I run a certain set of strategies, I can largely expect my future return to follow that distribution, assuming I know how to manage my risk.
The applications of blockchain are as such. Where can technology disintermediate rent-seeking brokers who have enjoyed monopoly power for a long time? And there's a whole host of places that can occur. At the moment, given the current speed of blockchains and the processing power behind them, exchange of value has turned out to be the most popular use case, i.e. cryptocurrencies. But over time, the technology will evolve and other applications will emerge.
Thank you very much, Matt and Nico, for that presentation and for entertaining our questions, for honoring our invitation to the book club. I think this has been most wonderful time spent and a lot of learning in that 1 hour.
Thanks very much.
Yeah, and Tom, and this goes for everyone else in the crowd, I'm sure Sam can share our contact information with everyone. We're local Seattle folks, like most of you, and this is an asset class that we're extremely passionate about and study and interact with on a daily basis. Please feel free to reach out if you have casual questions or would like to talk more in depth about Strix Leviathan. We'd be happy to hear from you.